So again, different strategy for different people, because you have to consider your own circumstances, how you trade, how long you trade. I know, for example, Jeremy prefers to buy and hold for quite a while, right? So Mick otherwise is very active trader, so you have to consider your own circumstances. Okay, I put 3 strategies kind of here. It's a long-term buy and hold strategy. So when you buy and hold for quite a long time, so in this particular case, you can buy at 48.50. Okay, I believe it might go lower there. Now it's 56. I presume it can easily go 10% down, and then hold until 110 or above, possibly 2-3 years, right? It gives you up to 120% profit plus dividends, which you're going to receive on the way. Okay, then roll strategy. So buy and sell usual technical analysis. So if you buy at 48.50, sell it here, it's roughly about 10% profit on roll. But each roll happens how quickly? So for instance, here, 1, 2, 3, 4 days, right? 1, 2, 3, 4, 5 days, 1, 2, 3, 4, 5 days. So it's like week up, then week wait, week up, week wait. Okay, so 10% every week, not bad kind of, right? If you consider to trade. Not always you're going to get it, because for instance, if you bought it here, you're going to sell it lower here. So you're not going to make this 10%. Here, if you sell, majority of time, you probably exit on that red candle. Here, you're going to exit on red candle. Here, it's on this red candle. So sometimes market opens lower, so you don't collect all the 10%. So you will be exiting on a trailing stop loss. All right. And then option strategies. So let's have a look at options. As you can see, they have only monthly expiration. So this Friday, then July, they don't have August or September, only October. So I presume when this expiration is over, and next Monday, we will probably see August as well, maybe even September. Okay, so it's not so many expiration dates. Secondly, the strike prices $2.50 apart. Okay, $2.50 apart. So which is not, again, fantastic for us. It's much better when dollar spread, or maybe even less. And when we look at the spread here, 75, for example, if we look at next 3 days, at the money, close to at the money, $55 strike price, so it's 75.90, so it's what, 15 cents. Not bad. Here it's pretty bad, 57.50 strike, what, 45 cents spread. Maybe it's because of volatility last night, maybe because the market was closed when I was taking the screenshot, but it is pretty big spread. Okay, so if we go for July, we're going to get $2.5 for put, which roughly what, 5%, a bit less than 5%. But remember that that period is over earnings. So 15th of July, we're going to have earnings. And I believe that 5% a month during current volatility is too low, especially if you go through earnings. You go for 48. Same thing, Dory, because when you sell put, naked put, or you buy share and sell call, you have exactly the same risk. Absolutely, risk profile is exactly the same, totally. Because in this particular case, for example, if you buy shares at the current price and then sell call, right? So what happens if the share goes? So whatever price you paid minus the premium you receive, right? In this particular case, you take the strike, 55, deduct the put. So very, very similar. Very similar in this particular case. The risk profile, very, very similar. But you can consider that if you want to. Like what it's possible to do is to sell put on the low if it drops, and then it moves up to buy it back. But you can see the spread is quite high here. So that's why personally, I would look at this, and most likely I wait the situation like that. Okay, this handle is pretty good. The only thing which I don't like that the low is still lower. Okay, and the high is not higher, so it still didn't go through. Okay, There is volume is a bit higher, so it's good for us, but still, I would probably wait until it goes low. Okay, and all indications will be in place. And when I see something like that, I enter a position and I buy it because I can make 10% within a week on that trade, rather than to have 5% in a month and also have a risk over earnings. So if I enter this position, I will try to exit it before earnings. So that would be my particular strategy. And I know if I'm wrong and if it drops down lower, everything can happen on the market. I'm quite comfortable after that start selling covered calls. So like that, okay, or wait until it recovers back. Okay, so covered call in this particular situation will be for me as a plan B. Okay, in case if I don't make this 10%, then I will be selling covered calls. All right, okay.